Good morning, and thank you for joining us today, Thursday, May 14th, for our webinar entitled Retirement Programs in Today's Changing Times. This is Denise Keddy, and I am your moderator for this session. A couple of quick housekeeping notes to be aware of. Before I introduce today's expert panel, the webinar today will run about 1 hour. Please take a moment now to visit the handouts area on your dashboard to download a copy of the presentation. If you don't see the dashboard area on your computer, go to the top menu, click View, and then click the section that says Handouts so that you can download the presentation. If you have questions during the presentation, please post them to the Q&A area on the dashboard at any time. If you would like your question directed to a specific panelist, you can note that when sending in your question. Our webinar today is being recorded and all accompanying materials are protected by copyright. Our presentation today provides general information for your information and does not constitute any legal or CPA or financial advice. The information offered today is during the webinar is as of May 14th, 2020. As always, we recommend that you consult your CPA or financial professional to address your specific situation and ensure you have the most current information, especially regarding any coronavirus or COVID-19 related rules or regulations. Let me introduce our panel of experts today. Linda Duffy, President of Ethos Human Capital Solutions. Linda and her team are known for building the magic of human connection with their consulting, recruiting, training, and also payroll support programs. The Ethos team works with your company by developing strategies for business leaders to get the right systems, people, and culture in place within your organization so that you as a business owner can focus on running your business and achieving your goals. Our next presenter today is Phuong Jennings, Regional VP of Sales and Consulting for Economic Group Pension Services. Phuong is a qualified 401k administrator and has close to 20 years of experience working with financial professionals, CPAs, attorneys, and trusted advisors to help companies and business owners establish and implement 401k pension plans for their company. Our next presenter is Dalia Badajos, Managing Partner at Benefit Management Specialist 360. Dalia is a certified 401k professional with over 25 years in the financial services industry. Dalia's understanding of the investment and insurance industry help her work with clients to understand their goals and design investment solutions to ensure her clients meet their goals and stay in compliance while meeting their fiduciary responsibilities. Thank you all for joining us today. We really appreciate your time. Linda, would you be able to kick us off and discuss the HRCR credits?
Yeah, thanks so much, Denise, and welcome everybody. Glad you can join us today. We actually scheduled this months ago, so I was really happy when Phuong and Dalia agreed to present for us because this is definitely not my expertise, and so we wanted to make sure that we brought some experts in to speak with you today. Marla Robinson, is typically on these webinars. She's in the process of closing some very big deals for some of her corporate clients. So she just says hello, but couldn't join us today for this presentation. We did apply for HRCI credits. So for those of you that have an SPHR or PHR certification, we did not hear back from the people at HRCI in time to give you that number today. However, if you do have one of those certifications and you want credit for this, you can do one of two things. You can go ahead and in the question section right now, just type in HRCI and we will provide you with an attendance certification. So that way, at least you can keep record that you were here. You can always, of course, just log into the portal and manually enter the information about this presentation and the fact that you attended today. So either one of those are perfect. And again, if you want us to give you a certificate of attendance, just put an HRCI into the question and we will pick that up later. All right, I'm going to go ahead and turn it over to Phuong. And this is an easy presentation for me because I don't have to do anything more. So Phuong, take it away.
Sure, thank you so much. Thank you, everybody. Welcome. We're really honored to be able to come alongside Linda and her team and present to you some of the changing landscape to the retirement plan space. So as far as our agenda for today, we're going to cover the CalSavers program, which is the new California mandated retirement program. We're going to talk about the pros and cons, talk about the important deadlines, and also what the requirements look like. So we're really going to just open up, and have you take a look underneath the hood of that program. Then we're also going to, Dalia is going to cover the Secure Act, which is another new enhancement setting up every community for retirement enhancement. That came out at the end of 2019. It is the most comprehensive legislative retirement changes that we've seen in years. So we're going to talk about the highlights of those new enhancements so that you have an awareness of what's going on. And then more current is the CARES Act, which I know we've all have heard so much about CARES and CARES, the Coronavirus Aid Relief and Economic Securities Act. There are a lot of changes within the CARES Act that impacts your retirement plan. And so specifically the new distribution rules and the enhanced loan changes. And so we'll discover and dive deep into that. And so we'll begin here. Next slide, please. Okay, so let's first talk about the CalSavers program. As I mentioned, it is the new state-mandated retirement program, and it is for any employer in California or employers with 5 or more employees in California. So if you are a company that is not located in California but have California employees, so there's payment coming from EDD for the state of California, then this applies to you. It is a program that basically states that if you don't have a current qualified retirement plan, such as a 401k, a SEP IRA, any types of those programs, then you have to go into the CalSavers program. And so all employers that qualify for this, that actually has to be mandated to go into this program, if they don't offer their own retirement plan, have to register for CalSavers and facilitate all their employee access to be a part of this program. We'll talk more about that. As far as the features of automatic enrollment, that is a special feature in the CalSavers program. What this means is that it is completely voluntary for employees. However, there is an automatic enrollment. So the employees don't get to pick or don't get to have a say initially if they want to be a part of this program. The employer will automatically enroll them if they don't make a decision, and that employee will have to opt out of the program. One by one, the individual has to opt out. Otherwise, they automatically are enrolled into this program. And then Census College Savings is the record-keeping services that manages the assets for this program. So a little bit more about CalSavers is that, as I mentioned earlier, if you do have a current qualified plan, we're talking about 401k plans, 403b plans, which are for nonprofit, 403b, I'm sorry, for the nonprofit communities, 401a, and then 403a plans are essentially profit sharing plans. So without 401k feature, you can have an employer only profit sharing plan, and that would satisfy a SEP, a simple, which is the savings incentive match types of retirement programs, or if you have an IRA deducted program, it has to have automatic enrollment in order for it to be a qualified exempted program. And then sometimes companies will be a part of what's called a multiple employer plan. And so those entities will qualify and do not have to go into CalSavers if you currently already offer it to your employees. Next slide, please. So as far as eligibility for CalSavers, it's a very loose eligibility. in CalSavers, as long as the employee is age 18 and they work in California and are W-2 wage employees, they qualify. So consider for, the food industry or retail, where there's a revolving door of employees that goes in and out, or seasonal employees. Anytime those types of companies hire anybody over the age of 18, after 30 days of employment, they have to enroll and automatically enroll their employees into CalSavers. And that automatic enrollment that I mentioned earlier starts at 5%. It is after tax, so it's Roth, which means there's no tax incentive for the individual, because they pay the government, the state takes out their taxes first, and then with that after tax, it's an after tax contribution that goes into CalSavers. And then every single year it increases 1%. So it starts at 5, every year it increases 1% all the way up to 8%, until 8% is reached. Then that person is at the 8% deduction. So participants, as mentioned, can opt out. They can automatically opt out electronically. They can call CalSavers directly, because this is all governed and run by our state of California. So there's an 800 number, there's an email address, and there's also hard copies that they can mail into CalSavers. So it is the individual, the employee's responsibility to take action. If an employee opts out, where they say, you know what, no thank you, I don't want to do this, they can do so. But however, every 2 years it resets. So there is an open enrollment period where if I was the employee and I opt out today, in 2 years, my employer has to automatically put me back in, and I have to continue to opt out once again. Otherwise, money will be taken out of my paycheck. That's essentially how this works. So the Roth IRA limit for the CalSavers program is just like your traditional Roth IRA. It's $6,000 for the contribution limit. Plus, if you're over the age of 50, it's another $1,000. So essentially, $6,000 or $7,000 is the maximum that somebody can put into the CalSavers program. An individual can put into. Now, be very careful that the income threshold, the AGI, which is the adjusted gross income, for individuals, filing single or married, is applicable here. So, if as an individual, if you cannot go out and get, and contribute to a Roth IRA, that means you cannot participate in the CalSavers program because you make too much. And this, again, is the individual's responsibility to know their income. Because keep in mind that if, let's say, I work for an employer and my husband works for another employer, my employer doesn't know how much my husband makes to know if we're part of this, if we exceed this AGI limit to not qualify me for CalSavers. So it is up to the individual to tell their employer, nope, I don't qualify. Otherwise, they're going to have problems later on when they file their taxes. Okay, and there is no employer contributions attached to the CalSavers program. So there's no need for employers to put any match or profit sharing. And then the registration deadline in order to comply and be in compliance with CalSavers, or if they don't have an individual plan right now, they have up to these registration deadlines to get their own individual plan. And we'll talk more about the pros and cons of that. But as far as how this has been rolled out, was that CalSavers originally, for the groups of over 100 employees, the deadline was actually June 30th of this year. However, with the COVID-19, this has been extended to now September 30th. So they've given us 3 more months. So if you're an employer with 100 or more W-2 employees in California, you have to either register for CalSavers or set up your own retirement plan by June 30th of this year to be in compliance. And then keep in mind that the number of employees is really tricky because that 100 employee count threshold is looking at the average of your last 4 quarters. So essentially what CalSavers indicated is that they're going to be pulling on an annual basis a report from EDD of the last 4 quarters and of how many W-2s, were reported for each employer. And they're going to take that as an average of the last 4 quarters to determine what number count threshold you meet. And so the next deadline would be those with over 50 employees, but under 100 have until June 30th of 2021. And then the last group are those with over 5 employees have to register or have their own plan by 6/30 of 2022. As far as compliance goes, if there are penalties if you're not in compliance. And so what that means is that after 90 days, if you're not in compliance of your deadline date, CalSavers can impose $250 for each employee. And then after another 30 days after that, there's another penalty, which is an additional $500. So essentially it's $750 per employee to be out of compliance for CalSavers, which is a really hefty bill to have to consider with everything that's going on. And it is all the employer's responsibility as far as registering with the state by the deadline, setting up all the employee accounts. Remember monitoring, the 2-year reset, for those that have opted out, but also reporting when people come and go, and then also submitting those employer contributions or those employee contributions on a per payroll basis. There's no advisor that is managing this, so there's no outsource that you can really have to help with this process. The burden really goes back to the employer, the company, and there's no third-party administrator. So let's talk about the fees involved here, okay? The employer fees, there's really no hard dollar billable, but, as I've already, talked about all the roles and responsibilities that the employer has to take on, it's really the time and money that they have to spend on either, hiring an HR person that manages this process, or if it's a small business, the owner is going to have to wear a separate hat, an additional hat to what they're currently doing to be in compliance. The employees do pay a fee for the management of the funds. And there's a table here that I indicated where it's typically anywhere from 92, 93 basis points to 1%. So it's a little under 1% is what the employee is going to pay for the management of their investment. And then as far as investments go, there's only five funds to choose from. It's very limited. There is a default, meaning that if the employee does not choose what investment to go into, then the first $1,000 goes into a money market, which really they're not earning anything. But of course, as I mentioned earlier, they're not earning anything if the first $1,000 goes into the money market, but they're paying a 1% or close to 1%. So essentially, there's a loss there from the get-go, and then there are and how it's being tracked is that each employee is using their Social Security number, and that's how it's being monitored. So that when the employee leaves, from one employer to the other, they're using their Social Security number. So it starts, it continues to accumulate. That's their account. So this is what employers have to do to either enroll or certify that they are exempt. Certifying means that they already have their own plan in place. So they can go to the CalSavers website. If they want to be proactive, go out there and they can request for an access code. And that's what's shown here right now from their website. And then once you're in their website, you can request, once the code comes back to you as the employer, because you have to go out there, request the code, which comes back within anywhere from 2 to 3 business days. And so once they get the code, then the employer goes back on and they can then go into and start to register. And so what you see here in the screen is that when they're registering, they're their company information. They're going to ask for their EIN. They're going to ask for that information, the access code, and they can certify. And it's a little small and fuzzy to see, but it's really saying that do you currently offer a qualified retirement plan to your employees? That's under the certification screen. And if you put yes, you put no or yes, but if you put yes, then there's going to be additional questions that does ask you what type of plan you have. And that's where, the employer can go ahead and indicate that they have a profit sharing or 401k or whatever plan that they currently have. So just to recap, as far as the responsibility of what the employer has to do, they have to collect the information from their, regarding their employees. They have to register. They have to really delegate and assign a payroll representative, really a payroll person. And I can tell you, in talking with a lot of payroll companies, a lot of companies use, let's say a big company like an ADP or Paychex, or even a smaller payroll companies. That's not a role and a functionality that they're currently involved with. And so this really does go back to the employer having to take on this new task. Okay, so they're setting up payroll, they're updating all that information. Okay, so as far as with employers, and I've told you a lot about what's going, what the rules are and what's required. And then, we talked about, there's alternatives. So with employers that says, what if I don't want to have, to go into this plan, this CalSavers, can we do something else? Absolutely. You can go ahead and set up your own individual, your own company plan. So it's basically through a private sector. You can, contact a TPA, which is what we do at EGPS. We can run some hypotheticals, some plan design options, and compare as far as design and cost. And then, Dalia here, that's on our call, and she'll be speaking right after me. She's a retirement plan specialist advisor. She can also go over plan options as well. But it's good to explore, because it may not, as far as cost and what you get for setting up your own plan, there are other options, and it's a way to outsource a function like this. And then as far as employer match or any type of employer required contribution, I think there's a lot of misconception that companies think that, hey, if I set up my own 401k plan, that's going to cost a lot of money, what's that all going to look like, and do I have to give employer contribution? The answer really is no. We can design the plan according to your goals and objectives, and there's ways to pass non-discrimination testing to make it worthwhile. So here's just a quick case study. So you have a side-by-side comparison. Here's just a small company with 8 employees, 8 W-2 employees. Their California registration deadline is June 30th of 2022. Now, if we mirror exactly the same feature as CalSavers, and we're going to use the most restrictive, age 21, 1 year of service, semi-annual entry dates, which are, January 1st and July 1st. Now, keep in mind, this is in comparison to CalSavers that says, hey, after age 18 and 30 days of employment, you're in, right? So we mirror the same thing, except for the flexibility that we get to customize your own plan. You're going to see that this employer with one, there's one owner and then 7 employees. Okay, and with CalSavers, the owner who's making $200,000 in compensation, let's say, is not eligible to contribute. So him or her, this owner has to offer CalSavers but cannot contribute themselves. And then let's say, all the employees, they get to, put in their 5% because they're all auto enrolled in at 5%. That's what the employees are putting in. Now, if we mirror that to the 401k plan, and we do the same, feature of auto enroll at 5% for the employees, that owner actually in a 401k plan can exclude the last 3 people who don't satisfy the 1 year of service, right? So there's only 4 employees that are actually in the 401k plan, and the employer can also put away $14,000. And so that's where there's the apples comparison. You can see that there's an advantage there for the business owner there. So why have a 401k plan? And I know we're talking about 401k plans because it's the most, it's the most known plan out there as far as a retirement plan. It's an employee benefit. You can use it to retain, your current employee as a benefit. You can recruit employees because it's very attractive when someone's looking to get hired on. They want to know if you're going to offer them a retirement plan. There's tax savings. With a 401k plan, you can do both pre-tax contributions and or have the Roth feature, just like CalSavers. So you definitely have more flexibility there. The employer contributions are allowed in a 401k plan, and all employer contributions provided by the company to the employees in a 401k plan are 100% tax deductible to the company. So that's a great perk for business owners. And then as far as higher limits, in a 401k plan, you're able to put away a lot more. This year it's $19,500 with another $6,500 in catch up if you're over age 50. So you can see here that with an IRA, the limits are much lower. And then the owners, of course, like I mentioned, can contribute, and also the highly compensated employees. And then basically you can have more flexibility to build in better parameters on who you allow to be in your plan. And then as far as cost is concerned, most business owners do think, gosh, it's going to cost me a lot, But with most, of the time that they're not aware that they can actually, there's incentives. The government really is trying to push and is really trying to fill the gap of retirement for the American workers. And so with that being said, there are small businesses with less than 100 employees are eligible for tax credits. And as of recent, up to $5,000 for all the plan setups and all the admin fees for the first 3 years. So that helps. Every little bit helps. And so that is something that is out there and available. All right, so I'm going to turn this over now to Dalia to talk about the Secure Act.
Great, thank you, Phuong. Hi, everyone. So thanks for joining us. I'm just following up with Phuong, great, with the CalSavers program that she's been talking about. Just like the state of California trying to encourage people to be ready for retirement and put savings away, the Secure Act is a federal program that basically, again, focusing on doing something to help employees and the hourly wage people set money aside. So the Secure Act, again, setting every community up for retirement enhancement, became law on December 20th, 2019. And it's a very extensive act that was put in place. We're going to talk about 7 of the key highlights and key components of that. And again, there's a lot more to it, but we could talk about that on the sidebar if you're interested. But a couple things here. So first of all, the qualified plan setup deadline changed for qualified plans. So originally, qualified plans had to be set up basically by the end of the year that you wanted to have some sort of tax benefit. Now that the law has come back and said you can actually establish a plan after that year, up to the date you file your taxes for your company, including extensions. So that gives you some time in order to set up some of the plans in order to get that benefit. 2, increased tax credit for plan establishment. As Phuong just mentioned, the original tax credit was for 100 employees or less was $500 per year. They've increased that 900% by saying that now you can actually have a $5,000 deduction for the first 3 years, which equates to $15,000. So depending on the size of your plan and employee group, that may cover most or if not all of the expenses for those first 3 years. So that was a huge benefit. In addition to that, number 3, they offered a provision that says if you actually include in one of your benefit designs an automatic enrollment, they will additionally give you another $500 tax credit. So if you have a plan in place and you don't have that auto feature and you add that, you can have the $500 credit. Or if you're establishing a new plan and want to add that into your plan, you can have that $500 credit. So that, again, another $1,500 of credit for you and your company. So as more people continue working into their 70s, they came back and said that even after 70 and a half, the government will allow you to contribute to your own IRA. Originally, you could not do that at that point, but now they're realizing that people are continuing to work. I expect those numbers to change in the future because we all are working a lot longer and living a lot longer. And so right now, they're going to let you contribute to your IRA after age 70 and a half. 5, delayed RMDs until age 72. So another benefit here is RMDs referring to required minimum distribution. So as you know, when you participate in some type of retirement plan, a lot of times you are doing that on a pre-tax basis. So you are contributing and not paying taxes. Well, the government turns around and says, at one point we want our tax money. So at 70 and a half, originally they required you to begin taking out a certain amount of money depending on how much you had in your account and what the life expectancy is. And now they've actually pushed that off to age 72. So that is great news for a lot of people because there are a lot of people that don't want to start taking their money at 70 and a half and are being forced. So age 72 is now the new age where you are required to take some of your retirement monies. There's also number 6 in the Secure Act. They expanded what is considered a qualified distribution on 529 plans, which is another savings vehicle. And 529 plans, they're allowing an individual to use $10,000 of the funds from your 529 plan to pay for any student loan. Originally, student loan dollars were not allowed to be paid through 529 plans, but now they are. So that's a bonus. In addition to that, if there's a sibling involved that also has a student loan, you're allowed to use $10,000 for them as well. 7, so as you may know, that anytime you put in a qualified plan, what makes it qualified is there's actually a qualified document outlining the guidelines for you to follow in your plan. And so if there's a change in the plan, typically you want to make the change and then you have to provide notices to the participants in at least 30 days in order for the plan that to go into effect. Well, because of the Secure Act, they are being a little bit lenient to that, and they are saying if you want to take some of these new provisions and apply those to your plan, we want you to amend your document by the end of 2022 plan year. So that just gives you some time. You get to start putting things in play and then work on the document after the fact. So there's a lot more provisions. There's, just to let you know, additional regulations that are allowing individuals who work less hours at your company after they've been with you a long time. So those are provisions to be aware of too. And again, we can get into those in more detail at another time. So I'm going to hand this back over to Phuong, and she's going to talk about the CARES Act.
Great. Thank you so much, Dalia. So I get the privilege to talk more about the CARES Act, which has been passed as of March 27th due to COVID-19. So the CARES Act, our government is so clever the way that they always come up with these acronyms, but it stands for the Coronavirus Aid, Relief, and Economic Security Act. And so lots of impact there as far as the retirement plan is concerned, and also IRAs. A few items to consider that is highlighting here is the new distribution option. So it's almost like a enhanced or an additional in-service distribution that's being added to the plan. Expansion and enhance on the ability to take out loans. The waivering of those required minimum distribution, the RMDs that Dalia had just mentioned. There's been some extension of deadline on funding, making those contributions for the required defined benefit or cash balance plans. Those are those pension plans that you have to, as an employer, you're committing to putting money in. Well, with the CARES Act, it's giving some relief and some other additional relief. Okay, so let's talk first about the distribution provisions within the CARES Act. The coronavirus related distributions, we call the CRD. These are the new optional types of distribution events, and it's available for all, the qualified, the 401k plans, and also defined benefit types of plans under certain rules, and also IRAs. And it's available before the end of this year, December 31st. It is available for those that are still employed with the employer, but before they reach the age of 59 and a half, they can take out the CRD distributions. There is no premature distribution penalty, which is, again, that's the relief there. They actually have an employee, each individual has the ability to take up to $100,000 in distribution because of this CRD relief. And basically they have 3 years to pay it back. So if I'm affected by COVID-19 and I decide to take $100,000 in a CRD distribution, I have 3 years to actually pay that money back. So that's what that looks like. And as far as defined benefit cash balance plans, they can also provide the CRD, but within the defined benefit cash balance plans, it has to be after age 59 and a half for the employee to take advantage of the CRD benefits. As far as the loan provisions are concerned, these are basically enhancing the loan program that if your current 401k plan already allows for loans. What it looked like before the CARES Act was that employees were only able to take 50% of up to 50% of their account balance. Okay, so if I have, $50,000 in the past before the CARES Act, I can only take $25,000 if I was to take out a loan. Well, now with the CARES Act, I can take the whole $50,000 if I want. It's 100% of my account balance. And then the dollar amount has also increased. So in the past, it was 50% or $50,000 was the maximum. Okay, so now I can actually take up to $100,000 of a loan. I'm not limited to just the $50,000 cap. And this only applies, and be very cognizant of this timing, is that it's only applicable for loans that are initiated within 180 days of the CARES Act. And so what that means is that by September 23rd of 2020, any employees that want to take advantage of this new enhanced loan provision needs to do it before that date. There is also a delay in the repayment as part of the CARES Act loan provisions, and that basically extends that any outstanding loans from a qualified plan. So if you have an existing loan, you could actually defer your loan repayment, which applies for new loans and existing loans. And it delays it for up to a year. So, which is really great because people are, there's financial situations where people can't pay, or you're going to take out this loan, this $100,000 loan, you actually can defer your repayment for a year. Okay, and then a little bit, just to dive a little bit deeper into the required minimum distribution waiver, the RMD. That has also been, there's a waiver there in that if you had to take out your RMD by the end of this year, the government says, you know what, we're going to let you, have a free pass. You don't have to take it out for the year. It's been waived. And so so keep in mind, if you had a RMD for the 2019 year end that you had to have done or take out by April 1st of 2020, that has also been waived. So it really provides for people, relief in that manner. However, keep in mind that if you have a defined benefit plan, the pension cash balance plans, those types of plans, the RMD rules and waiver does not apply. So you're still going to have to take out your RMD from these pension plans. Okay. So the CARES Act and the funding delay relief. If you're a single employer and you have a defined benefit or a cash balance plan, essentially if you have to fund those plans because they're required every year, you can delay those now. And if you're going to do that, though, keep in mind that the interest will still accrue, although you don't have to deposit that money in, right now. But the accrual of the interest still applies. And then the due date for making those contributions is now extended till January 1st of 2021. So an example of that is if I have to fund my 2019 pension plan, and I had to do that before I filed my tax return in 2020, which if it's put on extension, that could put me all the way till, September 15th of 2020. Well, now this delay is allowing me to extend it further, so I don't really have to put money in until January 1st of 2021 or make those contributions. Okay, and the tax extensions have also been in place where the tax filing extended from, April 15th to July 15th. So it provides more time as an employer for me to make those deductions. So I'm going to turn this back over to Dalia to recap on the CARES Act.
Great, thanks, Phuong. So the summary of what Phuong just spoke about, I've had clients that call me they know that the CARES Act addresses something that they have a question on, but it's been a little bit confusing for them as to where to get some of the answers. So we re-summarize this, and this was kind of an easy go-to sheet for them in regards to looking at answers to some questions. So regarding distributions and withdrawal changes, tax favored withdrawal penalty-free coronavirus-related distributions are allowed up to $100,000 between January 1st and December 31st of 2020. Repayment of the coronavirus-related distributions permitted are permitted as long as it's within 3 years from the distribution. Some may not want to pay, some might not be in a position to pay that back, but if you want to, they're going to allow for you to put that money, redeposit that money back in your retirement plan. 3, coronavirus-related distributions will be included in individuals' taxable income, and that can be spread out over a 3-year period. The other last item there is a mandatory 20% withholding normally applies when you take a distribution from your qualified plan, and they're going to actually waive that for now, so you don't have to get your distribution will not be minus the 20% withholding that happens currently or previously to coronavirus. Regards to required minimum distribution changes, those again are waived for 2020, and that thought behind that is if account values are really low, they're not going to force people to take out money that they really don't need. Plan or IRA beneficiaries receiving distributions over a 5-year period. So some have exercised a 5-year strategy for distributions from their plan, and the government is allowing them to skip this year for their distribution. So sometimes you take out, to get a tax benefit, you have to do it over 5 years. Well, normally they'd have to take out money this year, and they're going to allow them to delay that, to extend that a year. Regarding loan changes, the planned dollar limit for loans will temporarily be increased to the lesser of $100,000 or 100% of the participants' vested account balance, as long as it's within 80 days of the act that's in front of us. Another item for loan changes, 1-year delay of loan repayments. So They do not have to worry about repaying the loan this year, but they will have to start addressing that next year, and it will be calculated that way. In regards to plan changes, all plan changes and plan amendments, again, they're allowing a delay in that. And for the coronavirus distributions, RMD waivers, increased loan limits, which these are all optional to the employer to include or not to include. These are required to be amended in the plan beginning on or after January 1st, 2022. Defined benefit changes. This is important for those who have defined benefit plans. Single employer pension plan funding relief by delaying minimum required distributions to January 1st, 2021. So those employers who were required to make a distribution this year, a lot of them by September 15th, they're getting the extension to the 2021, or basically December 31st of 2020. 2, the plan sponsors may elect to treat the plan's funding percentage, which is a big part, for plan years, which include 2020. So a calendar year, the same as the funding percentage required for this year. So every year there's a funding percentage that is required by an employer, and they will allow you to look at last year's funding percentage to be this year's funding percentage, because if the account value is low, normally the employers would have to come up with a lot more money to fund, but they're going to give them a break and allow them to do the same they did for last year. And they're going to allow that funding again to occur prior to January 1st, 2020, but they will have to include any interest that is due for the people who are eligible for that qualified plan. And that, I think that does it.
Yeah, you know what, Dalia, there's actually a really important detail that, if I may add, is that the eligibility of who qualifies for these CRD loans or these enhanced loans, or sorry, the CRD distributions and enhanced loans, there is a qualification clause. So I want to touch on that real quick. It's basically any individual participant or his or her spouse or their dependent that must have been diagnosed with COVID-19, or any individual suffered adverse financial consequences due to COVID-19, for instance, furlough, reduction in hours, unable to work due to childcare, loss of business. So those are the qualifications, which it's kind of like almost everybody.
Right, and the comment there too is, to add to that, is those are self-certified, right, Phuong? So that
right, yes,
the employees themselves have to certify. The employer doesn't necessarily have to get involved in the certification, but the employees have to self-certify. And obviously, if there was anything out of line, they would have to deal with that.
Right. Great.
Great. Thank you, ladies. We appreciate that. We do have some questions that came in. I just want to remind everybody, if you dialed in a little bit late, make sure that you download, because there is so much information in this presentation, make sure that you download the presentation from the handout section. It has Dalia's and Phuong's contact information in case you need to reach out to them. Let me start with some of the questions. We have a couple minutes. So in regards to CalSavers, can the employee limit contribution each year at 5%? I guess
so I can answer that. Yeah, no, the answer would be no, because if they were automatically enrolled through the 5% auto enroll rate, they have to do the auto increase because it's part of the rule. Now, it can be different if the individual elects a different rate, meaning that, hey, you know what, I don't want it at 5%, maybe I want it at 4%. Then the employer will have to honor that. But if it's through the auto enroll and I did not make a decision, then my employer will automatically have to follow the rules of CalSavers, auto increase every year 1%. Hopefully that helps.
Okay. Okay, we have a question that came in, a clarification question. I have a defined benefits and profit sharing plan for my employees, 100% funded by the employer. Do I have to offer a CalSavers 401k program for my employees to be able to contribute? That's part one. And can I offer a CalSavers 401k program as an additional option? This has like a 3 or 4 part. So why don't you start on that part and then I'll read you the rest.
Yeah. Well, with a defined benefit plan and a profit sharing only plan, that actually is part of the exemption types of plans. So the answer to your first question is that no, you do not have to offer CalSavers because you can be exempted. Now the second part I'm hearing is that, you know, should you want to offer CalSavers, could you do it? I would say why not? I mean, it's kind of like you can be exempted, but they're not saying, there's no rules out there that, hey, if I want to offer it in addition, that I think they would actually want you to, if anything, would be a positive than a negative.
I think the only qualification or caution there is that if that employee needs to be aware that they need to follow the Roth contribution rules and the salary income limitations that are there.
Okay, so and now we have a couple questions that came in regarding obviously COVID has changed things up a bit. So if a participant is still working and no one was diagnosed with COVID-19 in their family, but their spouse was laid off or terminated, can the participant take a CRD or expanded loan due to the family's loss of income?
I can respond to that if you want, Dalia.
Sure.
Because from everything that we have read, you know, and keep in mind that there's not a whole lot of language defining a qualified individual except for what I mentioned earlier. So based on the fact that if the participant's still working, no one was diagnosed with COVID-19, and but their spouse was laid off and terminated, it appears that it would not qualify, because we do believe that there is still an oversight in this definition. We're still seeking out additional guidance on that because it's a little bit of a gray area.
That's a good point, David. When some of the last webinars too, there's guidance that still needs to come out, so it's always a good reminder to look back and talk to your financial professionals if you have any questions for your company. And then Dalia, I think you can get this one. Are the new distribution options stated in the CARES Act only allowed up until 12/31/2020?
Yes, the distribution, yes, those have to be taken basically this year. If they're, because they're really, everything, you have to kind of think about it, even though a lot of this stuff has not been clearly communicated, and we're still trying to get determination on some scenarios. A lot of that is, you know, they're trying to help people through this time. So right now if you're going to take any distributions, that has to be done 2020.
Okay. And can you repay part of the COVID distribution in part, or do you have to, when it comes back, do you have to pay it all off?
No, you don't have, first of all, if it's an actual distribution, you don't have to pay it at all. But if you want to replenish your retirement fund, yes, you can contribute what you can contribute back to it. So if you've taken out a $100,000 loan and you have $50,000 to contribute, you can recontribute $50,000.
Right. And I would say that, you know, that I agree that, you know, a participant, if they choose to, they can repay part or all of it back to their, you know, qualified plan or their IRA. And really the advantage there is, or disadvantage, if you will, is that any amount that's not repaid is now considered taxable. So whatever they pay back is not taxable, but, you know, if they have a remaining balance, then they pay the taxes on that.
Okay, I'm going to do one last.
I have a question.
Yes, go ahead, Linda.
So what I want to know from you guys is, like, when I first heard about the CalSavers program, I was like, okay, this is good because, everybody should invest for their retirement. And then now that I've heard you guys discuss it, not just today, but on previous occasions, it sounds like this is not a great plan for employees to invest in. So if I'm an employer and I want to try to do the best I can, what would the next steps be? Like, if somebody wanted to reach out to one or both of you to just understand what their options are, how would you approach that? Like, what would you do for them to get started?
Well, I'll take that one. So the first thing they would need to do is just obviously consult what their goals are, but the information that generally is needed in order to do an analysis is basically what we call a census. So that's hire dates, employees, and salaries. And so we take that information, and basically I work with somebody like Phuong at eGPS, and we do different scenarios to share that with the prospect in regards to analyzing which direction might be good for them to go. And that includes costs, fees, and we include all of that analysis and walk them through the steps. It can be done rather in 2 months, but typically a good analysis takes about 3 months to do a thorough job. To see what's going to be best for them. So that's why auditing whether CalSavers or a qualified plan it's the wise thing to do, because you want to take that into consideration.
And if they don't get it done in time by the deadline, and so they by default have to enroll their employees in the plan, can they put a plan in after that deadline and then get out of CalSavers?
Yes, they can.
Yeah.
Absolutely.
I've heard that. I've heard that. Yes, they say, let's just say that the 9/30/2020 deadline. Okay. Once you get to that point, there's going to be a little bit of lag time before they can even run these reports and kind of go after you, so to speak. So I think there's a little bit of wiggle room in that if they don't establish their plan by 9/30, but maybe it's by October 15th, and then they certify that they're exempt, I don't think that's going to, cause an issue, because there's a 90-day period as well in between that we mentioned of being out of compliance, right? That's where it incurs the penalty cost. So I think definitely there's time, because of what Dalia indicated earlier too, there's a lot of back and forth, and part of the analysis is really more presenting, and then there's the decision making, going back and running numbers and all that. That really, time is of the essence to start, looking at options or other viable options earlier on than wait till 9/30 to do it.
Right. And I'll just say, I put in a 401k plan for Ethos. We only have, I think I have 6 employees total. It wasn't all that expensive. I'm doing a match because I wanted to be able to maximize how much I personally put in. So I'm doing a safe harbor match. But I think in terms of like getting it set up and plan fees and all that sort of stuff, it's maybe $2,000 or $3,000 a year. It's like not that much. To be able to have an investment vehicle for myself or my employees. So I would just encourage everybody to reach out to Phuong and Dalia. Their information is here on this slide. And Denise, I'm sorry I jumped in on your questions, but let me go ahead and wrap this up since we're coming up on the noon hour. And so just say thanks to everybody for participating today. We typically only do 1 webinar a month, as you know, but everybody's been calling about, how to bring employees back. Some of you receive PPP loans, others, as the governor releases guidance on who can return to work, there is a ton of sort of requirements on who can come back and when. And so we're doing another webinar on Monday. We already have about 165 people signed up for that webinar. So that gives you a sense of how important that is for everybody. We are actually going to move it over to Zoom. Denise and I decided today because we can have all the participants on, and we didn't want to get cut off at 100. So the registration will be through GoToWebinar, but if you register in this link, you'll get another email from us giving you the link to the Zoom webinar platform. And just also know that we're starting this at 10 a.m. on Monday, and it will be at least 90 minutes long. I'll stick around as long as needed to answer questions, but the presentation is pretty detailed, and we just will walk through everything you have to sort of think through in order to bring people back, and sort of what the guidance is from the state and the rules surrounding returning people to work under the COVID-19 cloud. Hey, Jennings, any final thoughts or anything other than
No,
thank you to Phuong and Dalia?
nothing right now, but again, if you had questions and we didn't get to your questions, we will follow up with you after the webinar. But thanks everybody for your time today. We know how hard it is to step away, and we appreciate Phuong and Dalia participating and being able to answer some of these questions for everyone today. We look forward to seeing everyone at our webinar on Monday.
Thanks so much. Bye.
Thank you.
Thank you.